Good morning. Good morning, everybody. Thank you for watching Taxes Made Easy. And again, got a lot of interesting news today, a lot of policy issues. But we're going to be focusing on financial assets and how does IRS treat them. So 401ks, IRAs, stocks, bonds, CDs, bank accounts, business bank accounts, their whole life insurance, term life insurance, and as well as digital assets. There's a lot to consider here, and it's important to know, how do you protect your assets? How do you make sure that the IRS isn't going to come after your assets and um, seize them? So we've got a lot to cover here, and we're going to be going through this in depth. So again, if you have any questions as we go through this and how does this affect your particular situation, give us a call, and we can review your situation in detail. Welcome back, everybody. Thank you for watching Taxes Made Easy. So we've got a lot to cover today, and we're going to jump first of all to just kind of some simple stuff from the IRS. So again, just like a lot of different, they've been having a lot of these announcements lately. But again, Virgin Islands got hit with various, again, this is for Ernesto victims, and they're expanding this to the Virgin Islands. So again, putting out certain deadlines, if all the way out to February 3rd, 2025. So it just goes through what it's touching on here. So if you have a valid extension to file your 2023 federal return, the due date now is February 3rd, 2025, if you're in these disaster areas. Also, quarterly estimated income tax payments normally due September 16th and January 15th will both be due February 3rd, 2025. Just gives you more time to make those payments. Doesn't get rid of the need to make those payments, though. So be mindful of that. But it helps avoid some interest and penalties if you need a little bit more time to pay those, given the disaster that and the damage caused by Ernesto. Again, quarterly payroll excise tax returns normally due on October 31st and January 31st are both kicked out till February 3rd, 2025. So if you have any questions, again, these are all directly in the news section. You can click directly on tax relief in disaster situations, or there's a summary that I've touched on before as far as getting that relief. So if you question, do you qualify? Do you fall in one of these areas? Talk to a CPA, and it's all on irs.gov. You can look up all of this information online. So another quick announcement from the IRS came out yesterday. Employer educational assistance program. So if you work for someone that helps pay for educational assistance, pays for tuition, schools, books, equipment. Here's kind of the list of things that they can pay for. That's what they've traditionally been used for, but since, and I believe this goes with the Trump tax cuts, you can also use those to pay principal and interest on a employee's qualified education loans, so student loans here. So payments made directly to the lender, as well as payments made to the employee may qualify. So you get the tax benefits of making those up to $5,250 per year. If you're interested in that and your employer offers these kind of benefits, talk to them, see if you can't use these to pay off your student loans and save some money. Sorry, clicked on the wrong thing. So good information here. If you do fall into that situation, look into it, and it's something, if you run a business, it's something you might want to consider offering your employees. Whether or not this will continue depends on what happens with all the different provisions of the TCJA, and that'll be determined by December 31st, 2025, one way or the other. Now, something that surprised me, and mainly because I don't smoke, I didn't know that Walmart, CVS, and others have ended cigarette sales for years. So CVS, Target, Walmart had already stopped selling tobacco products. Maybe this is why we're seeing so many smoke shops pop up in different places, because the average stores just aren't selling them. Um, I'm kind of neutral on this topic. While I do think if it's their people's right to smoke and do different things, on one hand, we're encouraging marijuana use and approving that and expanding marijuana, and in many places um, legalizing much harder drugs than marijuana. It seems like cigarettes are the redheaded stepchild of you know using drugs. So nicotine has gotten a really bad rap. Smoking, not saying it's a good thing. Vaping is something that's become a huge health hazard. Not to say using other forms of drugs isn't, drinking and stuff, but again, it's what's popular, etc. So again, there's just a whole list of stores. So the article here is Stop and Shop announced that they're going to stop selling cigarette products. So I guess you go to the smoke shops or you go to gas stations that do sell them still, etc. It's not something I've noticed as a non-smoker, but I think it's kind of ironic that they're targeting smoking so much while encouraging the use of other drugs. So go figure. There does come a point where people do have rights to live their life how they see fit. And again, it's a political decision. Do we give them more rights for overall health? Is it good for people? No, but neither is a lot of the other drugs that people are taking. Going in a different direction, talking about one of the costs that's hitting people, and that's actually that's a lot of car insurance ads talking about increasing car insurance premiums, and this is something that people are seeing, something that we've seen personally in my household. Again, car insurance premiums going up, and they have been going up, and it's predicted that they'll go up another 50% in many states this year. So we have not hit the highs, so inflation ranges from one part of the economy to another, and we have not fully seen the impact from this.
Unfortunately, for many here in Nevada, auto insurance rates are about to get even higher.
So
hundreds of
again,
thousands of drivers are going to see a nearly 20% increase in their
car prices are finally
Customers
going
are
down.
not happy about it, but they say there's no way
But
out.
to afford these vehicles, insurance rates have gone up.
Only
So
this kind of present nobody wants. Robert Diaz has been a State Farm customer for 14
got up to an
years.
average of
His car insurance rate
$2,329
has jumped nearly
for a
$200
year,
in the last 2
for
years.
the first half of 2024. That's a 15% increase from 23 and a 48% spike when compared with 2021. And then it's expected to go even further
And he says shopping
higher,
around for other companies
a lot
isn't an
higher by the end
option,
of the year.
despite
So
his perfect driving record.
some of the worst states here, Minnesota, projected 61% increase in car insurance on average. That's brutal. You have severe weather events causing a lot of this.
According to Insurify,
Severe
New York had the
storms
most expensive
with
car insurance
golf
in
balls,
2023, followed by Nevada,
hail the
Florida,
size of golf balls
Delaware,
and baseballs.
Louisiana.
That's
The
kind of
Nevada
scary.
Division of Insurance says there are a couple of reasons prices have
Missouri,
been rising.
The first, I would say, is the cost.
estimated
of new and used
55% increase in car
during the
insurance.
pandemic,
California,
they shot up consistently and
54%
really haven't come
increase.
down. The second is
It's
the
just
complexity of new vehicles. So when there
scary to
is
think
an
about.
auto
So
accident
shop
and
around,
vehicles
look
need
for
to be
deals,
repaired, the cost of those repairs
but
have gone up.
be prepared. It's
Nevada's Division of
a lot of people
Insurance
are
has to
commuting
approve all car
less,
insurance increases. This year's price hikes are unprecedented.
using your
We have
cars
seen a
less.
lot
When
of
I started
carriers,
working
a lot of
remotely,
large carriers
my car insurance went
submitting
up.
rate increases
And so
over
we
the
had
last
to
couple of years.
revisit
Before,
things.
as
We're
I
still with the
mentioned, you
same
might get
carrier,
one
but we
every
had to
3 years.
hold the
Now
phone,
we're getting one probably
and
every
call them up and say what's going on and adjust some things.
because of the losses that they're taking.
The DOI
why
says
you
they want
have
to make sure they protect their consumers, but they
through
also
since
will
COVID, the
usually
price of
approve
new and used
reasonable
cars
rate
has
increases
gone
so
up
that the carrier
sharply, even
won't
though
take the
prices
state.
have
In Las Vegas, Sunnyside,
slowed
Fox
down
News.
recently over the last 4 years. It has gone up dramatically. There's supply chain disruptions and not only vehicles and parts, making them more expensive to replace and repair. One of the big issues here is we don't have enough mechanics. So everybody wants to go to college. Not enough people want to just work on cars. Again, our education system is driving everybody to college rather than the trades. And people completing post-secondary programs in the automotive sector has gone down by 20% since 2020. So we need more mechanics than ever, or automotive technicians, and that's decreased by 20%. So that's not a good thing for car insurance. So again, a lot of this is driven by insurer losses, not gains. They're not making money off of most of this. Again, be mindful of this as you go and look at car insurance. Be mindful that it is very well could be cost more, and so shop around, talk to your car insurance provider, and see what they can do to help you out. So next article, this is actually something I have mentioned, and there's a push mainly among Republicans to outlaw IRS direct tax filing program. Now, this is a very popular program. Anytime everything's given out for free, people tend to enjoy it. We all like free stuff, don't we? The problem is nothing's free. So, and this is the whole point here. Congress did not authorize this, so it's not authorized directly in the law. And that's something that I might have skipped over it. There was an article talking about having a lack of congressional authority for student loans. It's another big thing out there. So the big concern here is, and it's called the IRS Overreach Prevention Act. It would stop the free public electronic tax filing return service option. So basically, this is something that they just did. They tested out in 16 states. Now they want to expand it to all 50 states. And it sounds great to, hey, just have the government. We can go to the government, file our tax returns, and get our tax returns prepared. There's a couple concerns there. First of all, those that are proponents say, taxpayers save $5.6 million in tax preparation fees. There were already plenty of free programs out there where you could use third-party systems, but now all of this information is going to the government. So again, there was one of the big concerns is that it's hurting TurboTax, H&R Block, Intuit, Jackson Hewitt. A lot of these tax preparation services are getting killed by this. And I'm up against the brick. So we're going to have to continue this when we come back. Welcome back, everybody. So just kind of going into this, and this is raises some of the concerns that I've raised in the past about having the IRS prepare your tax returns. First of all, there's no buffer between individuals and the IRS. So you're giving them all your information. What actually shows up on a tax return, yes, you have W-2s, 1099s, but especially if you're self-employed, if you have any kind of income, I mean, you pretty much are revealing your finances to the IRS. And if you trust the IRS not to use and abuse your information, I'm sorry. That's exactly what they've done over the years, using metadata and other things to see exactly where people's money is going and to take advantage of this. So again, this could be a very insidious idea, or could be used in ways that actually hurt taxpayers. So again, if someone has a simple return, I don't see a big deal with this. But overall, what you're doing is you're making the IRS act as your tax preparer and accountant. The IRS is not going to give you advice on how to save the most in taxes. They're not going to sit down with you and review your situation, make sure that you are avoiding tax liabilities. Again, the IRS just put out this last week, I think it was 2 days ago, I talked about how important it was to sit down, review your tax situation, making sure you're not going to owe. You can't do that if the IRS is your accountant. And if there's any mistakes, who do you go to? How do you amend your tax return? How do you talk to someone where you can get tax advice and good advice if the IRS has prepared your tax returns? If there's any kind of mistake, who do you complain to? There's nobody, because it's the IRS. So it's a massive conflict of interest for the agency that is already weaponized against hard-working Americans. And I agree with that statement. So having a government-run tax preparation system is a really bad idea. And one of the things that people that are supporting it cite is that, look, they do this in other countries. Well, yeah, in China, you don't know what your tax bill is. The government just takes what they want to take. There's no back and forth. There's no making sure that it's done right. You don't have anybody fighting on your behalf or advocating for you, which is what we do all the time. And it would give the IRS the expanded ability to predetermine what taxes they owe and then just audit them, because they already have all your information because they prepared your returns. So while it sounds good and people love free things, there's a lot of problems and a lot of ethical issues with this down the road. So we'll see what happens down the road, if this continues or if it falls by the wayside. I do see problems with it, but again, it's hard to tell people, look, this free thing that you have might bite you in the butt in the future. And once it becomes enshrined, again, it's not only going to squeeze places like H&R Block and Jackson Hewitt and Liberty Tax, it's also going to squeeze CPAs and tax preparers. And we need more good tax preparers. We need more good CPAs, and we don't have enough of them. That's something that is not being pushed in our schools, is accountancy, and there's a huge demand for that. So I want to jump to the next article real quick. This was huge news yesterday. Supreme Court came out and pretty much smacked down Biden's student loan bailout. It was very questionable to start. Biden administration kept doing it, kept announcing we're going to forgive student loans here, there, everywhere. Sounds like a Dr. Seuss book. He had no constitutional basis to do this, no authorization from Congress, and with no authorization, the president can't just make up stuff on his own. We have a constitution, we have a rule of law. If he wanted to do this, he should have gone through Congress, where it had no chance of passing. So again, the High Court denied an emergency request There were no dissents in this, interestingly enough. And so there's a nationwide injunction on the student loan bailouts right now. So they just ruled that against Biden on this plan to unilaterally use tax dollars to forgive student loan debt. Again, no noted dissents. This is his safe plan. I've had people pitch this to me, saying, "Look, if you use these different plans, you can save a lot on student loans." And it sounds like a great plan. You can, even if you're paying your loans, you can avoid a lot of the penalties and interest, etc. But who ends up paying that? Taxpayers. So there are already companies that were marketing this and trying to get people to save up for it, sign up for the SAVE plan, just like the ERC or other programs that the government has pushed. And so it's really going to be interesting to see all of this unwind. Everybody that signed up for this and had their loans forgiven could all be unraveled because the Biden administration didn't follow the law. And they knew this was constitutionally suspect. So again, this creates more confusion. People think their student loans are being forgiven, or they could be forgiven. And now all of that is backfiring because it was done in a very constitutionally suspect way. And in my opinion, it scored cheap political points. So last thing I want to talk about is some unrealized gains proposal. And this is from Breitbart News, which is definitely a right-leaning source. Interestingly enough, they have a video here that I'm going to share from CNBC talking about this. So this is an economic panel from CNBC, and let's give it a listen here.
And sure, and all the revenue that comes in from these unrealized gains taxes and the other taxes in the Harris plan are going to go to creating what she calls more opportunity. It's to make sure that every newborn born in this country gets $6,000.
Using the services.
Well, look, you're arguing that this is some sort of foreign concept that's completely unknown in the U.S. tax code.
It's probably unconstitutional. It's probably, and it was never in anyone's intent to
income.
tax.
It's not an income tax,
and it's never going to happen. Probably. Not I'm not going to say my lifetime.
I wouldn't say that.
Not in Becky's lifetime. Yeah.
So interestingly enough, I've seen the same video shared on other news sources. This is directly from CNBC. Economists calling this out. And so the gentleman in the middle with the suit is Kamala Harris, economic advisor. The idea behind this is that they're going to take all of this and use this to pay off all the tax cuts that they're suggesting, pay for all the child tax credits that they want to do, to pay for a lot of the program spending that they want to do. Now, a couple things here as you go through this. It's very possibly unconstitutional. If they try to pass it, it's going to get sued like crazy. Does it have a chance of even passing? No. And this is taxing people for when their stocks go up, but they actually didn't sell the stocks. If your company becomes more valuable and you get taxed on the increase in value in your company, even though you didn't take any money out of it. So taxing people for money that they didn't actually receive is the idea. And so to make it economically palatable, they're only proposing on for those making more than 100 million, or no, people that have total assets of more than 100 million. So this is a very small number, about 10,000 people in the entire country. And this is a typical strategy, is if you have an unpopular tax, say we're just going to tax it, put it on the rich. That's how income tax started back in 1913. It's just going to be on the rich. Didn't stay that way for long. And this is their proposal to make sure that the wealthy pay at least 25% minimum tax. Going after things like this is going to be a huge problem. It's going to take a lot more in taxing. When you're taxing the wealthy, the uber wealthy like this, where's their money? It's not sitting in a bank account because it would be losing value to due to inflation. It is invested in the economy. So if they put this tax into place, it's estimated would reduce GDP by 1.6%, reduce wages by 1.1%, and cost us about 666,000 jobs. So again, when you tax the wealthiest Americans and you tax them, you're hurting everybody because they're the ones that are investing in the economy. And if you take all that money out of the economy and give it to the government, which is so good with money, sarcasm alert, it's not going to lead us to prosperity. So again, it goes a lot more into the details. And I don't want to get into too many details here. It talks about how it probably won't pass the House or the Senate now. But one of the concerns here is that if you start talking about it, one of the things they want to change the definition of income. So by changing the legal definition, they're hoping they can expand it. The current Supreme Court is smacking these things down right and left, but if you got a liberal Supreme Court, they might allow a lot of these things. So they talk about 100 million assets. Sounds great. One of the Democrat senators from Oregon proposed doing the same thing on 10 million in assets or 1 million in income. This will hurt and hit a lot of business owners with 10 million in assets. If you own a few franchises, that's going to hit you. And if your franchise goes up in value, you have to have that reevaluated. And our last article for the day really does turn into, take a deep dive into this. This is from Investors Business Daily. Really takes a deeper dive at what people are thinking about it. So talks about the current law. There's no tax on an asset until it's actually sold. So stocks go up, stocks go down. And they're saying, hey, it would only apply to the uber wealthy. Don't worry about this. But mentions Ron Wyden's proposal to tax those for people making a lot less. They have different numbers here, but again, topics front and center. And the more they talk about it, once it gets put into place, it usually, almost always, these taxes the threshold gets lowered and lowered until it is hitting a lot more people. Most of the business owners, people that are producing jobs, providing for jobs, and the more it gets expanded, the more job growth and GDP growth will get hurt. And that's typically what happens when you tax people. The money goes to the federal government, and that money is not used well. So you're taking away from GDP, and the government is highly inefficient. So, and the kicker here is by this huge tax on the uber wealthy, it's not going to balance the budget. This is just part of their plan, one piece of paying for $5 trillion in tax increases, which probably isn't going to happen. And they're going to spend more anyway. This is what the trajectory of government spending has been. And to be fair, Republican or Democrat, post-COVID, it's gone into overdrive. But we have to get serious about cutting spending, and nobody's serious about that. Trump has put some feelers out there and suggestions out there, but it doesn't have a solid plan for actually cutting spending. And that's what we really need. So again, it talks about, will it actually become law? Not likely with our current makeup, but if you have a Democrat sweep in the House and the Senate, or in the future, it could happen. Again, talks about this being applied to a lot more people, very possibly. And is it even constitutional? So want to move on to the topic of the day. So I kind of skimmed through that. It gets a little more in detail than I want to focus on right now. But again, it's really goes to financial assets and growth in the economy and what's going to help our economy and what's going to hurt it. Because in the long run, the only way to tackle our national debt is to stop the damage, stop the spending, and help let the economy grow. So as long as we're overspending and, and again, both parties want to cut taxes, they have their programs they want to do, they have to have something that they're going to push. And that usually costs more and more money when we're already in the hole. So looking at your own financial situation on an individual level, a huge part of what we do is we help people stop spending or overspending, pay their taxes so then they can move forward and address the issues that they're facing. So first step here is save what assets you have. And if you have a 401k, IRA, Roth IRA, other kinds of investments, there are ways to save a 401k. We've talked about this recently, how you can lock up a 401k if you're still with you're with an employer and they offer a 401k program. You can typically go and take a loan out against your 401k. The rules vary greatly by 401k plans. So if you're not sure if you can, you need to go talk to your HR department. They'll know if you can take a loan out against your 401k. If you can't access it, then that's a good thing. It means that it helps people keep that 401k in place and maintain it for their retirement. If you can take a loan out and you use it for allowable expenses, then you can lock it up per se with a loan, but you can typically only do that as long as you're still with the same employer that you sponsored the 401k. If you move to a new employer and roll it over, the loans have to be paid off, and then you can roll it over in a new 401k, but they don't always allow you to take loans out with a new employer, so you have to check on the details of each plan. But typically the IRS does not allow for payments into a 401k. So this is one of the big things that hit people is when they are putting a lot of money into their 401k, their IRAs, whatever retirement accounts that they're contributing to, the IRS won't allow for those contributions when you owe taxes. They want you to stop putting money into your retirement and start paying them. But they will allow for 401k payments, but you have to argue for it. Whereas they used to allow that without question, now they're contesting a lot of that. So it's not a given that they're going to allow for those 401k payments, even though they should be allowed. If you don't have it in a 401k, if you have a Roth IRA, stocks, bonds, CDs, just normal investments, the IRS says, look, cash. And they'll give it an 80% valuation and say, okay, use that to pay off your tax debt. If you can prove that you can't access those, it's in I had someone that had an investment in the Middle East, and they couldn't sell it. It was a privately held firm, couldn't sell his stocks or interest in the company, and had tried to. We were able to eliminate that as an asset when speaking to the IRS. So it all depends on how liquid it is, and especially when you have funds or investments through your company, if it hasn't vested yet, you don't have rights to it yet, they can't demand that you access those assets as well. So this gets into some legal terminology. But again, if you have questions, we can go through those, and these are the questions that we ask. And talking to your HR department, you can get these questions answered, whether or not the IRS can go after them or whether or not you can protect these assets. So we're coming up on another break here, and we will continue the conversation when we come back. Welcome back, everybody. So we're talking about financial assets and how you can lock those up, and if they haven't vested, if you have rights or a pension, if normally, or it's typical that you have to work so long at a company before you have rights and can access those kind of accounts. If they haven't vested is the legal term. If you don't have a right to it yet, then the IRS can't access it. So interestingly enough, if If you have mandatory pension dues or mandatory retirement, you get credit for the payments into the system plus any loans. And so if you have a normal 401k, IRA, and it's voluntary, then they can't, then they can not give you credit for those payments. So that means that if you're putting $500 a month, the IRS is going to say, oh, well, you could just pay your taxes, your past due taxes with that $500 a month. But if you work for a union or for a government agency that has mandatory retirement, so either the federal or state government, and there's mandatory retirement requirements, that means the government, your employer, automatically takes that money out. You are mandated to participate in the retirement program. That's a condition of employment, and so this typical for unions and government workers. Not all, but many. If that's your situation, you'll get full credit for your monthly contributions to the retirement plan and program, but you'll get full credit as an expense for any loans or anything else like that. And they have to leave that alone. Typically for pensions, especially government plans, etc., like that, you can't access that until you retire. So it protects that asset from the government. If that's your situation, that can really help you out as well. So other kinds of assets, just the other day we talked about the difference between being retired and in retired state versus not. So if you're of a retirement age, 62 or older, you can start drawing off of retirement assets to help pay your bills through retirement, nearing that retirement age, and usually incomes go down and people rely on their assets in retirement. The IRS will allow for that. But if you're not retired yet and you have all these assets, the IRS sees it as, hey, that's a pot of gold, give us the money. So when you're getting close to retirement, planning for that, be strategic with when is the right time to present your financial information to the IRS. Might make sense to maybe just get on a payment plan, something where they're not looking at your financials or kick the can down the road a little bit until you can protect the vast majority of your assets. You can even do an offer and compromise with large assets like that, because once you're using that to live on and support yourself in retirement, it changes how they classify that. And that's directly from the Internal Revenue Manual. And that's something that they do still follow. They might not like it, but it's something that they do follow. And I've gotten plenty of offers accepted with large retirement sums when someone is actually in retirement and drawing off of that. You don't have to draw a lot. You can choose how much you want to draw, $2,000, $1,000, even $500 a month. And that locks up that asset from the IRS. So I'm going to kind of switch gears here, and something I haven't talked about recently. The difference between term life and whole life insurance. So when you say here whole life, a lot of people aren't sure what whole life is, and that's because the life insurance industry wants it that way. So term life is very simple. You're betting that you're going to die. And the whole idea of term life insurance, when it first started back in, it was a common thing back in the around the time of the American Revolution. If someone died young, they would have a widow that was penniless and didn't have any way to support her family. It was a tragedy. It was a huge tragedy when a husband with a family died. And the idea between life insurance is that the community would pool their resources, and when they had a tragedy like that, whoever faced that tragedy, their family would be taken care of. But and it would be only for a term of years, because most of the time when people would later in life would have amassed an estate. So by the time you're hitting 50, 60, if you're prudent with your money, you should have a home that's nearly paid for. You should have retirements built up, etc. So the need for a huge life insurance payout decreases over time and eventually becomes, once, if you have an estate, you've built an estate, you really don't need life insurance. It's nice. But as you get older and you're more likely to die, the cost goes up and up for term insurance. It goes up for all life insurance, but it's, for term and whole life. If you're going to die soon or more likely to die soon, then life insurance is going to be a lot more expensive. But the idea behind term, if you get in early and you get a 20-year term and you develop a condition while you're already on the plan, they can't increase your rates unless the plan renews or it's part of the plan. But typically, if you get cancer or something like that, the rate while you're in that term doesn't increase. So that's term life insurance. Whole life insurance is just kind of a broad explanation or kind of a broad umbrella, because there's all kinds of words that life insurance companies use. Variable life insurance. I'm kind of blanking here. Pretty much anything with cash value connected to it falls under this umbrella of whole life insurance. So your mutual life insurance. I mean, they've used so many different phrases and they change it, and it's all for marketing purposes. But the overall idea behind it is pay us more money and you'll build cash value in your life insurance. So because this is, it's a lot more expensive than term life insurance, but the idea is, hey, you're going to pay us all this money over this time period. With a term plan, you get a $100,000 policy at the end of 20 years. If you die, you win, you get the money. If you don't die and you live, you don't get the money. But it's there as insurance for your family, for your state, whoever's relying on you. That's the idea the original idea behind life insurance or term life insurance. Whole life insurance flips it on its head and says, well, if you pay us enough money, a lot more money, if you die, you win. You get the life insurance. If you live to the end of the term, you get the $100,000 policy value, but you've paid into it to build up that value the whole time. So it can be sold as an investment vehicle, as a savings vehicle. The IRS treats anything that's not term as a bad investment vehicle. And there's plenty of arguments. I'm not going to get into that as to why, or is it really a bad investment vehicle? But that's how the IRS treats it. For term life insurance, they give you full credit if you're spending $100 a month on term or $200 a month on term life insurance, as long as it's reasonable. They'll give you full credit for the monthly payments. It's seen as prudent financial planning. If you have a whole life insurance policy, they give you zero, big fat goose egg, credit for the monthly payments. And then they go and they will tell you they'll demand the full cash value out of the policy. So, true story, I had one client and was not the most financially savvy. And unfortunately, she had a decent income, but she'd been taken advantage by far too many people. And she was paying $1,700 a month on whole life insurance. She had insurance on herself, on her family, on her son who was young and healthy, on relatives. So if they died, they would get a nice payout. And she was paying on all these different policies to the tune of $1,700 a month. That is pretty much a house payment. And so she ended up owing the IRS a lot of money. One of the first things I did is I went over her budget. Where's your money going? She didn't know. She had no idea that she was paying that much in whole life insurance. So when we looked at it, I said, look, go out and get a small term policy for yourself and your son if you want. It's easy to add a child rider or whatever. But we need to get rid of this huge expense that you're bearing. $1,700 a month that the IRS isn't going to give her credit for. And she has cash value in all these policies. So she cashed all the policies out, used the money for some allowable things, some health expenses that she needed, but some of it went to the IRS to pay the IRS. And then that freed up $1,700 a month in her budget to address her tax issues and other debts that she had. So again, release this huge burden off of her shoulders to move forward and address this. So it can really help to sit down and talk to a financial coach, a financial planner, someone to say, okay, review your finances. What decisions have I made that are really helping me, which are hurting me? Can I make a lot more money by investing directly in the market? And so if you haven't sat down with someone, that's not a service we provide, but we can review your situation and say, hey, you need to talk to someone about A, B, and C, or this is how the IRS is going to treat it. But ideally, you should have someone review your financial situation every 4 to 5 years at least. Have things changed? And how much has changed in the last 4 to 5 years? A lot. I would probably recommend that you talk to someone a lot more frequently than 4 to 5 years. But one of the things I want to focus on is other types of assets. So if you have income producing assets, they're usually left alone as an asset. For example, and this is hard to purchase, but mineral rights. If it's regularly producing income, the IRS will ignore it as an asset, but they'll look at the income stream and treat that as income. In New York, the big thing was taxi medallions. Now with Uber and Lyft, it's probably suffering a bit today, but historically that was a big investment that people would make and live off the income stream, or it would supplement their income. Rental property is a big one. So if you have a property that you're renting, it's treated as a small business. You look at your assets, and the IRS will typically leave those assets alone. Now, that's very true for an offering for a hardship status or installment agreement. Lately, if you have a lot of equity in assets, so if you have a rental property that has a lot of equity in it, the IRS will now treat that as equity for purposes of an offer and compromise, but they won't tell you to sell the property. They won't tell you to take a loan out against it. I mean, you could to get rid of the equity and move that money around, but there's ways to deal with it. So when you have income producing assets that you've purchased that aren't easy to just sell, you can take those funds, lock them up, but it creates an income stream for you. And that's really what you want, either growth or income to the stock market. But if it's something that's easily transferred into cash, like stocks, bonds, CDs, they're going to treat it like cash. So putting funds into things that are less fungible can protect the asset, but create an income stream for you to allow you to pay more in taxes or supplement your living standard. So if you have questions, does this qualify? Give us a call. I'll sit down and go over your financial situation. And what we don't do, we work with plenty of financial coaches. We work with business coaches if you have a business. We work with financial planners that can sit down and help you draft a plan, get a budget together, and invest, pay down debt, invest wisely for your future. That's really part of our goal here, is to be part of that team to help people succeed in becoming financially independent and improving their financial situation long term. There's a lot of job satisfaction that comes from that. From helping someone I was just talking to someone yesterday, been around, has his own business, widely respected in the community, and I asked him, "Do you know what you're making monthly?" He's like, "I have no idea." So we're going to help get him on track so he knows what his monthly income is, so he can plan and get ahead of the ball, feel like he's in control of his own financial situation. And if there are, he is dealing with IRS issues, why he came to us, we're going to help him plan to save as much as possible and his assets and set up a plan that works best for him. So again, it's very important that when you talk to someone that they're very flexible and that they will help you achieve your goals. So that's one of the things I sat down. I was like, what are your goals? What do you really want here? And, explained it to me. I'm like, okay, that's what we're going to fight for. And so it's important to have that, someone not try to force something down your throat, but also share with you what are you going for? What are your goals in life, and how do we help you achieve those and help you feel empowered? And that's not a word I throw around often, but really, when you help people gain control of their lives and of their finances, it really is powerful, and it really helps people feel better about themselves, about their future. And I can't tell you how many people come in, they're depressed, they're gloomy, and when they come out, they're like, I see a light at the tunnel. We have a path. I know what I need to do, and with your help, you'll get me there. If you have any questions, give us a call, 520-485-7371, or look us up online at guardiantaxlaw.com. And we are serious about helping people out, improving their financial situation now and into the future. Have a great day, and we will see you tomorrow.